Welcome to Investor's Guide and thank you for tuning in. This is the show that will help you build a perfect portfolio by looking at what your needs are and what suits your needs best. If you have any questions at all about your investments, write to us. Our email ID is at the bottom of your screen. You can send in queries to our Facebook page and you can reach me personally on Twitter. On the show this week, we help a young investor create a corpus of 5 crore rupees in 15 years. Pick up a pen and paper, we'll tell you how to do it. In our product review, we look at the ICICI Prudential Value Discovery Fund and we'll tell you if you can claim tax benefits on property that's on your father's name. All right, it's time for me to bring in Kumar, the CEO of Value Research and our in-house mutual fund expert. Thank you so much for joining us on the show. Let's get straight to our portfolio question. 36-year-old Amol has written in. He writes in from Gurgaon. Now, his goal, is to create a corpus of 5 crore rupees in 15 years for his own retirement and to secure his children's future. He sent us a list of the investments he's making right now. He has 2 homes, one he's living in, a second one that he's bought in Gurgaon on a home loan of about 30 lakh rupees. Now, he's bought a third property, which might be slightly stretching it on the property front in Nimrana. It's an under construction plan, although he hasn't borrowed for that one. He invests 40,000 rupees every year in his PPF account. He has health insurance and he puts about 30,000 rupees in mutual funds every month. Now, he wants to know if he's on track to achieve his goals. Now, before we talk about his mutual fund investments, which look very good, by the way, I want to talk about the fact that he has no life insurance. And here is a man who's planning to look after his children. He has no life insurance. He seems to have enough health insurance. There's that money going into PPF that he might not really need. And of course, the third thing we should worry about is the fact that he has overextended really on property, and there's a large chunk of his investments are in property right now. If you were to relook at his asset allocation, what would you advise him to do?
He needs to really reconfigure his investments. One is he should look at his new acquisition, the Nimrana property. A lot of investors get carried by, in fact, investors refer to real estate as investment. I think things could be changing. Things might not be the same as we have understood it in the last 10, 15, 20 years. The dynamics are changing. Also, the risk of, acquiring it, it's a leverage play. And if we are faced with a downturn or a situation where the prices don't go up, the Indian real estate dynamics is different because there is always a cash component involved in your real estate purchase, not necessarily in the kind of property which individuals buy, but definitely in the subsequent, the resale. And from that standpoint, Indian real estate, whenever we have seen a correction, it is not correction in terms of prices. You never come across a situation that a 10 lakh rupee property sells for 8 lakh rupees. But yes, that 10 lakh rupee property selling after 5 years is effectively a time correction, and it is a significant correction. So if you are looking at it as an investment, think of the kind of illiquidity you are assuming, the kind of risk you are assuming, and you will not be able to realize it. The other thing is that, to accumulate 5 crore rupee in 15 years time, your money need to grow, 75,000 rupee per month should go and earn 15% annual return to accumulate to 5 crore. And you have savings. You have about that much, 40,000 going into PPF and 30,000 going into mutual fund, an excellent mutual fund. All you have to do is, stop your PPF contribution, just make 10,000 rupee annual investment in PPF that will keep the account live, and move that money into equity fund, and don't necessarily act any new fund. Maybe spread your money in the same fund proportionately, and that should take care of it. This is a change. Of course, before this, you should think in terms of a term plan for 5 crore rupee. That will also be a significant annual cost of about 1.5 lakh approximately at your age.
All right, so it does seem like you are on track, but like I said, we're a little concerned about how much of your investments is in real estate and the fact that you will need to make about 15% from your investments to hit your goal. But the good thing is that's what's being expected from equity over the next 5 years. Let's take a look at his mutual fund portfolio. Very carefully chosen funds. Axis Long Term, BNP Paribas Tax Advantage, ICICI Prudential Dynamic, Reliance Small Cap, which he's stopped now. He's moved his money into the Dynamic Fund. iPro Top 100, Birla Sun Life Frontline Equity and HDFC Tax Saver. These are all funds that you have recommended on the show. All together, put together, do you think they make a cohesive portfolio? Would you like to make a change? You did say you'd like to make one change to his portfolio.
Yeah, I would like to make a small change. Is ICICI Prudential Dynamic Fund, he already has it, and it's a great fund to have. Maybe substitute the top 100. There will be some complementary things here, and 15-year time frame, just a large cap fund. Maybe he can substitute with a fund like, dynamic fund of another fund family. And he should also consider one more thing. He should try and take full advantage of the 80C. If he is discontinuing his PPF, then he should try and avail of the 1,50,000 rupee annual contribution to take the full tax break. And so he should increase his allocation to Axis long-term equity to the tune of 1.5 lakh per annum to avail the full 80C advantage, and substitute this ICICI Prudential top 100 with another similar fund like Quantum long-term equity or a HDFC equity.
So there you have it. That's the advice you're getting right now. Dhirendra, he has one very quick question for you. He says he has put money in the HDFC tax saver. As we know, it's about 4 lakh rupees right now. He wants to know, should he continue to hold that money, because if it's out of its lock-in? Should he distribute it among other funds, or is it fine in that one fund? Can he continue to keep it like that?
Yes, I would say that I would call HDFC tax saver as an above average fund, and he might as well hold it. But just in case he is running, of course, in his kind of cash flow situation where he's making these investments, I don't think he's going to face a cash flow issue. But for sake of simplicity, there is a possibility that over a period of time, for example, he has another 500 rupee which has gone into BNP Paribas tax saver. In the overall scheme of things, where you're investing 30,000 rupee, 500 going into one fund, I think it's an unnecessary distraction, because it does not translate into anything meaningful, even if you continue investing for a long time. So for sake of simplicity, just consolidate your money into funds where you are investing and continue investing.
All right, so you've picked good funds, and of course, if you need more help, you can write to us. Email ID is on your screen. Let's move on to our hold or sell segment. This week, 39-year-old Satish has written in. He writes in from Bangalore, Dhirendra. He's been investing in mutual funds for the last 5 years. He wants to know if his portfolio is on track. He has two very interesting goals, one of which is his children's future. The other one is his own retirement. And it's very interesting. What he's done is, because he's afraid of the volatility in the portfolio that he set aside for his children, he's used only blue chip and large cap funds there. And the ones he's using for his own retirement, he's gone slightly more aggressive. So let's take a look first at the two blue chip funds, Franklin India Blue Chip, DSP BlackRock Top 100. We just spoke about both of these funds last week. They're good, solid performers. Given that he's looking at investing for his children, though, is he straitjacketing himself a little too much into large cap?
Yes, but even going by the age of his children, even these investments are for 15 years and more. They are not short-term investment. So if he is really averse to taking, as and when he gets, closer to his goal, he should change his allocation. He should, move a reasonable part to fixed income, either or keep it in the bank deposit. Or if he is scared of the volatility which we face, then he should consider, a set of balance fund, which will provide him, greater stability than even the large cap fund. But my suggestion will be that, he should be into funds which are low maintenance. He should be into funds which are not very tightly defined, where they will be investing for all times to come. And these two funds will be. So I would say that, he should be considering our, large and mid-cap universe, or, multi-cap funds. Or better still, because both these goals are 15 years and, of course, one goal is non-negotiable. And the way to deal with the, non-negotiability of the goal, and to, not faced with this uncertainty, as and when you need the money, is to change your allocation. As you get closer to the goal, 5 years ahead of that, the money which you are likely to need 5 years from now, start moving a part of it methodically. The way you are accumulating your savings into these investments, you should start moving a part of your money into fixed income and completely de-risk yourself from the uncertainty of the market, as and when you are faced with the goal.
All right, that's the advice you're getting, particularly on the portfolio that you're looking at for your children. Dhirendra, let's take a look at the portfolio for his own retirement. Right on top is the L&T Equity Fund. Do you approve of this one being in his portfolio, or are there better options out there for him?
No, L&T Equity Fund is a decent fund, is a good fund. And they have also, even after the change of management, they have continued to retain the basic character of the fund. So I would say continue with this fund.
Well, another L&T fund in his portfolio right now, the Global Real Assets Fund. Dhirendra, continue this one as well.
This is a fund, which has done very well. It's very difficult to say get out of it. But at the same time, I don't see a reason, when you are going to be a passive investor in equity in an actively managed fund for next 15 years, is there a compelling case for all these times to come? And so maybe, this is a fund which does not, a theme which does not fit in. Of course, there is nothing disappointing with this fund. And so he should consider, why this fund should be in his portfolio.
All right, I'm going to take the next three funds together, Dhirendra, because you obviously are going to approve of them. Quantum Long-Term Equity, ICICI Prudential Dynamic, and the IDFC Premier Equity Plan. Would you recommend he continues all of these funds?
Yes, these three funds he should continue. And these are the kind of funds, which does not require looking at a large cap fund or looking at a mid cap fund. These funds change their color or opportunistically tilt their portfolio to derive benefit, and they have been able to build a very credible history.
All right, so if you'd like us to take a look at your portfolio, write to us. Email ID is on your screen. Dhirendra, a couple of more questions for you before we let you go. Mahesh has written in. He's retired now. He's 60 years old. He says he has enough medical insurance of 10 lakh rupees, receives a regular income of 25,000 rupees a month. He has 7 lakh rupees in his PPF. He wants to invest this money right now that he's withdrawn from his PPF in equity for a time horizon of 7 years. He wants to know where he should invest this money because it's a lump sum and he wants it to compound over time. So tell him this, first of all, Dhirendra, if he's pulled this money out, he has 7 lakh rupees sitting in a bank account, he wants to put it in equity mutual funds. Obviously, a lump sum is not a good idea.
Absolutely not. And in fact, he will be in for great disappointment. And it will cause him anxiety in his retirement, which is uncalled for. Because, if you look at the kind of, ups and downs which we see on a daily basis, and more so for a person who has accumulated his savings into PPF, and then moving his money into equity, he'll be watching it carefully. And it could be quite unnerving. So definitely he should be spreading his investments over the next 6 months to 1 year. The other is that I would not like him to move into an equity fund. I would like him to get into stodgier balanced fund from our stable growth portfolio. And so those funds, should be large cap tilted, the funds which are not taking, an undue risk with their equity portfolio, because even some of the balanced fund can face great volatility. That could be unnerving for an investor of his kind.
Well, Dhirendra, the interesting thing about an investor of his kind is that he's written in saying that he wants the money, so 7 lakh rupees to compound over 7 years and turn into 35 lakh rupees. Is that possible then if he does use stodgier funds that will give him more stable returns?
Yes, that is not possible. And he should, there's a small chance that it just might, this whole good times are ahead, and if that translates into, a great market performance, because 65 to 70% of his money will be into equity. All he'll be doing is approaching it a little carefully with a 35% fixed income allocation and not taking the whole exposure at one go. So there is a small chance that it might be achieved, but I'm not very hopeful that 35 lakh rupees in 7 years time frame. If you are definitely looking at this 7 lakh rupee turning 5 times to 35 lakh rupees in 7 years time, you are in for great disappointment, and it will not match your expectation.
Right, that's for sure. It's not going to match your expectations. But if you want to pick something stable that will give you a stable return without risking the money that you have right now, because you have taken it out of a capital protected PPF, then Dhirendra, they're recommending the funds that are on your screen at this point. Let's move on now to our fund review. This week we're looking at the extremely popular ICICI Prudential Value Discovery Fund. Avan is here to give us an introduction. Avan.
Thanks, Faye. Well, the ICICI Prudential Discovery Value Fund believes in the principle of value investing, which simply means the fund manager opts for stocks with low valuations whose fortunes are expected to turn around soon. These stocks may also have hidden assets which the market may not have spotted. Over the years since the fund's launch, it has followed a rigorous process of identifying fundamentally strong, well-managed companies which are out of the market's favor. The fund's bottom-up strategy ensures diversification across sectors and has shown remarkable flexibility in lean markets. When it comes to performance, the fund has taken the top spot and has demonstrated skill during the markets, which have been rising as well. This fund is suitable to investors who are seeking more returns with less capital risk in their portfolios. Since its launch, the fund has given more returns and cushioned its fall better than some of its peers. Investors who have held on to this fund have been rewarded with returns of up to 26% since its inception. Let's do the math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 9,861 rupees today. So despite the value trap risk, should this fund be a part of your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Aman, thank you for that introduction. Dhirendra, if we look at this fund, it has such a stellar performance, 91% over the last 1 year, 25% over the last 10 years. Is this the kind of fund we should all have in our portfolios? Are you absolutely pleased with the way it has performed?
Yes, but this fund is, likable for another reason, that, it has stuck to what it set out to do, which is be in out of favor companies or be relatively cheap companies. And it has been able to do so in the last 5-6 years. Before that, it had a very lean patch. It was a period when, in 2007 happened to be the worst period in the life of this fund. And one has to see, there could be disappointment ahead. If the market gets racy, then it will be very difficult to find the cheap universe, the part of the market which is still cheap. Yes, last 5-6 years, it has been a great run, and this fund has stuck to what it set out to do. And increasingly, I find that there will be a situation where this fund will struggle to pack its portfolio with relatively cheap stuff, cheap stocks, relatively. But yes, so far it has been a very disciplined fund. It has been relatively far too stable than other funds in its category, even compared, because of its portfolio characteristics, its underlying portfolio. It happens to fall in our mid and small category, but it is not a mid and small cap fund by design. It's a fund which says that it's a value fund, and it will try and find a relatively cheap stocks for its portfolio. So I have concerns about this fund, but this fund has been very impressive.
Dhirendra, we get a lot of messages and tweets and emails from viewers and from investors who write in saying, okay, the market's obviously going to do well over the next 5 years. What sort of fund should I invest in to take advantage of that run-up? Could this be one of those funds?
No, this is not the kind of fund which is trying to capitalize on the run in the market. This is a conservative fund. This is a fund which tries and spots a relatively out of favor stock. So this fund at times may be disappointing. But if the fund continues its belief and it's stuck to, it'll face, less speed breakers. It'll face less rough weather, because a bull market will come with its own share of, big dips in between. And this is a fund which will not ride the market as efficiently. For that, you have funds which, you have growth funds. And most funds, and that is a dominant universe. A large part of our equity fund universe try and, capitalize on the growth, and not this fund. This fund has done very well in recent times in the whole turnaround in the lean time of the phase of the market. Yes, if you have 2-3 funds, I think one must have a fund like this in your portfolio just to counterbalance. It's a worthwhile strategy to follow. And this fund has established itself as a high-quality balanced fund, a high-quality value fund.
All right, so it's a high-quality value fund. Dhirendra, what would you give it in terms of ratings? We're talking about the ICICI Prudential Value Discovery Fund.
I would give it a 5-star, and that is where it stands. It gets slotted even on our risk-adjusted scaling.
5 stars there for the ICICI Prudential Value Discovery Fund on Investor's Guide. If you have any questions about what you heard in terms of that particular review, write to us, or you can reach me on Twitter. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. Coming up after the break, can you claim a tax exemption on property bought on a joint home loan? Don't go anywhere. Welcome back. You're watching Investor's Guide in ET now. Thank you for staying with us. We brought in Suresh Surana again this week because you sent in so many questions on tax. Suresh, thank you so much for coming in. Let's get to our first question. Ravi Raj has written in from Bangalore. He took a joint home loan with his father, but he tells us the property is in his father's name. He wants to know, can he claim the tax exemption now, even if he's the one who's paying the EMIs? Suresh, obviously, the tax exemption will depend on where the EMIs are coming from and which bank account, but what do you think he can do about it?
Mr. Raviraj, since the property belongs to your father and just because you have taken loan and paid interest on that, that by itself would not be eligible for any tax deduction. Only if the property is jointly owned or if father gifts you part of the property and then you have also basically paid the loan in respect of that, then that may be eligible, but not in the present context.
Vinoy Thomas has written in. He is an NRI working in Bahrain. He wants to know if he needs to pay short-term capital gains tax of 10% on the profit he earned on shares that he sold from his NRE demat account, even if his income in India is less than 2.5 lakh rupees. I think, Suresh, at this point, he's confusing his income tax with his short-term capital gains tax. Do you want him to set him right on that one?
So, Mr. Vinoy, there is a short-term capital gains tax in case you are selling the shares through the recognized stock exchange and you are paying the security transaction tax, and the rate is applicable is 15%. The rate is not 10%, by the way. And secondly, in case of resident, they have the opportunity to claim the basic exemption up to 2.5 lakh rupees. They don't have to pay any tax. But in the case of non-resident, you cannot claim the the benefit of basic exemption. We also do not have any double tax avoidance agreement with Bahrain. So basically, you will have to pay tax at the rate of 15% on the short-term capital gain what you are getting on the sale of share through recognized stock exchange.
All right, so last question on the show. R.V. Rao has written in. He is the Karta of a Hindu undivided family. He has 2 daughters, both of whom are married right now. He wants to know if those 2 daughters of his are entitled to inherit property from him. If so, he wants to know if he can invest in ELSS or life insurance policies and claim a tax rebate if the funds have come from the Hindu undivided family funds. Suresh, what would you recommend he does?
Yeah, Mr. Rao, under the Hindu Succession Act, there was an amendment in 2005. So the daughters, including married daughters, are treated as part of the HUF. And you would be entitled to claim the benefit under the HUF for section 80C up to rupees 1,50,000. The investment in ELSS as well as any life insurance premium which is paid by the HUF for its members are eligible. However, investment cannot be made in public provident fund or national savings certificate by HUF. But subject to that, all the other eligible investments are available to you for the investment by HUF.
All right, Suresh, thank you so much for answering our questions, because that brings us to the end of Investor's Guide. Remember, if you have questions about tax, savings, spending, anything to do with your money, email ID is at the bottom of your screen and you can reach me personally on Twitter. Thank you so much for watching.